Well, welcome everyone to another exciting class. We're going to be bringing you today this new $10,000 down payment assistance program that IHDA has just come out with. It's something I think every realtor should have, and you should have in your briefcase a flyer that you can hand this out to any prospect at any point in time. I say here, did home ownership get easier? I think it got a lot easier when all of a sudden you're giving away $10,000 in down payment assistance that they can use for down payment and for closing costs. So, it's either, and with no monthly repayments. And then let's put it in perspective as to what the other IHDA down payment assistance programs are. I'm Glenn Marino. I'm the business development manager of First Centennial Mortgage, and Tony Marino is the branch manager. And Tony will be giving his insights into how he has seen it being used with some of his clients along the way here. So let's get started. A little bit about Tony. Tony is the branch manager of the Marino team in Naperville for First Centennial. He's a loan originator. He's licensed in Illinois, Colorado, and Florida. So if you have any Illinois clients that are moving to Colorado or Florida, Tony's the person to talk to. He specializes in getting people into home ownership using down payment assistance. And he uses education to help people understand how they can become homeowners and own a part of the American dream. The American dream, it's still alive and kicking. It's, buying a home, it can be an exciting and an intimidating process. Now, Tony and I believe in the American dream, and we feel most people still do, but they're unsure as to whether it's achievable anymore with rising interest rates and how much they got to put down with the down payment. This webinar will provide you with the information that will help your clients qualify for $10,000 in down payment assistance. This helps clients dream of home ownership. When you all of a sudden can provide them with the vision, the ability to get $10,000, they're all of a sudden going to be paying, they're going to give you their ear. They're going to be paying attention to what you have to say, because they may not have the $10,000, and now all of a sudden you're providing them with an avenue that they can journey toward home ownership. Why would they seek the American dream? Well, it's becoming a little bit of a buyer's market. Prices are coming down a little bit. There's a need or a want. Everybody wants that American dream. They want to become a homeowner. However, there's too much misinformation out there. So many people think I need 20% as a down payment, when in essence, some of the programs out there only provide you with or need for 3.5% down if it's an FHA loan, 3% if you have good credit on a conventional. And if you're a veteran, you don't need any. It's a 0% down payment if you're a veteran. They're going to learn to set aside their lack of confidence of becoming a homeowner. Many think they're years away from owning a home. They're stuck in being a renter. They just can't seem to get ahead. They can't seem to save enough money. Inflation is eating away with their utility bills, with their rents, with their cost of food, that they just can't save enough for down payment. 50% of the renters think they can't afford the down payment. However, they have the financial means to maintain monthly mortgage payments that's about what they pay in rent. And we're going to see that later on in this seminar, how the monthly payment with down payment assistance, what is that monthly payment as compared to what they might be paying in rent? They're going to find out about the financial assistance, down payment, and closing costs that are available to homeowners. And it enhances the quality of life, and it helps individuals with wealth building and equity appreciation. So why would you continue to stay a renter if you can afford the monthly payment? You build equity, you can build generational wealth by investing and becoming an owner in real estate. So what are the advantages of home ownership? Well, it's a place to own versus renting or living with your parents. It gives you stable housing costs versus rising rental costs. It builds equity that we just talked about. It builds wealth. You get tax deductions on the interest you pay on that mortgage and the real estate taxes that you pay. You can borrow against that equity that you build up in your home for future expansion, improvements, finishing off a basement, or you can convert it into cash later when you retire by doing what's called a reverse mortgage. And this is a key statistic. Homeowners versus renters have 45% greater net worth than renters. So again, why would you continue to stay a renter? Why not build wealth? So who can use $10,000 of down payment assistance? Well, renters can. We just talked about it. Existing homeowners. This is not a first-time homebuyer program. So if any of you realtors have clients out there that already own a home, this program is still for them. If they could use $10,000 for down payment and closing costs, because they'd like to keep some of their own savings for rugs and lawnmowers and rakes and shovels, that's a good thing. Sons and daughters of millennials. I've got clients, Tony's got clients that, well, they're already homeowners, but they have sons, they have daughters. For example, two of my daughters, one in Colorado, one in Illinois, they both have taken advantage of down payment assistance programs because, again, they were first-time home buyers. They didn't have all the money necessary, but they didn't want to continue to pay rent. So what they did with the advice of their dad is to become a homeowner, but they went out and got down payment assistance. Family members that dream of home ownership, they would be, brothers and sisters, aunts and uncles. They all have dreams of becoming homeowners. Your friends. Once you take advantage of these down payment assistance programs, it's easy for you to say something to your friends. Hey, I just got into home ownership. I just got $10,000. I didn't have a monthly repayment on that $10,000. This is what allowed me to become a homeowner. Why don't you give Tony a call? Why don't you give my realtor a call and see how you too can take advantage of this program? It's anyone who thinks they can't buy a home because they did not save enough money. Remember, again, we think inflation's eating away at the savings base of many of the people. So if they don't think they can get ahead in saving enough money, then the down payment assistance program is for them. And it's anyone who's interested in buying a home for less than your first month's rent and security deposit. I know many people who are renting a house, they're paying anywhere between, say, $2,000 to $3,000 a month in rent. Well, with the security deposit, it's also $6,000 or $4,000 that they're giving to the landlord. Wouldn't it be nice if you only had to come up with 1% of the purchase price? If you're buying a $300,000 home, 1% is $3,000. That is your entry into using the down payment assistance program. You must come up with 1% of your own funds. Buying a home is a huge step, but buying a home doesn't have to be that challenging. If you're just missing the down payment, maybe Tony, maybe those realtors that use these down payment assistance programs can help their clients. So what if we can help with that missing down payment? Well, it's going to help an individual overcome a financial barrier to home ownership. It's going to give them the financial assistance to give them money for down payment and for closing costs. The Marino team through Tony can provide you with access to the IHDA programs. There's $6,000, there's $7,500. There is a $10,000 repayable program, but the new one is $10,000 with no monthly repayment. We're going to see details in a shorter period here. So here's the four programs. Let's talk about them real briefly. The $6,000 program. Well, it's really $6,000 up to a maximum of 4% of the purchase price. So $6,000 is a forgivable grant over a 10-year period. And what we have to remember here is all of the down payment assistance programs, all four of these are second mortgages. So you're going to get your regular first mortgage, be it an FHA loan, be it a conventional loan, be it a VA loan, whatever loan is best for you, that's going to be your first mortgage. But if you still need money for the down payment, you can take out a second mortgage from Illinois, from the Illinois Housing Development Authority. And this one is a 10-year forgivable grant. So if you live in the house for 10 years, it will be forgiven over that 10-year period. If for some reason you don't stay in the house, say you stayed in it only for 5 years, well, that means 50% of that grant, of that $6,000 has been forgiven. So when you sell the house at the end of 5 years, that means that when the attorney for the seller, because now you're selling the house, he's going to ask, well, what's the payoff letter on the first mortgage? What's the remaining balance? And he'll also ask IHDA, what's the remaining balance on that grant? And they'll say $3,000. You'll pay back the unforgiven portion when you sell the house. Pretty cool. The $7,500 program. Well, I used to call this the Crazy Great program because, again, it's a zero interest loan. There is no monthly repayment, and you only had to pay it back once you sold the house. There is a limitation that it's up to 5% of the purchase price, not to exceed $7,500. So again, it's a second mortgage, zero interest, zero monthly payments. And so again, if I live in the house for 10 years, at the end of 10 years, my attorney's going to ask, well, what's the remaining balance on the first mortgage? Then he's going to ask IHDA, what is the remaining balance on the $7,500? IHDA's going to come back to him and say, well, it's $7,500. You never made any payments for 10 years. The very great thing is there's no interest on it. So it's only $7,500 and it's going to come out of sales proceeds when you sell the home. Crazy great. Where was this when I was buying a home? The $10,000 program, repayable, is again, its limitation is up to 10% of the purchase price, not to exceed $10,000. So again, it is a zero interest loan, but it is repayable over 10 years. Well, 10 years times 12 months is 120 payments. Divide 120 into 10,000, it's $83.33 a month. So under the repayable program, your client would pay $83.33 a month in addition to their first mortgage payment. Now comes the great one, the new $10,000 program. It looks just like the $7,500, but you notice there's no limitation. It does not matter what the purchase price is. It's not limited to 4% of the purchase price. It's not limited to 5% of the purchase price. It's not limited to 10% of the purchase price like the first three. There is no limitation. It is a flat fixed $10,000. There is no interest on it. There is no monthly repayment. So you get to give your client $10,000 toward their down payment, toward their closing costs. They never have to include it in their debt ratio. There's no monthly payment. And if they stay in the house for 10, 15, 20 years, however long they stay in it, at the end of that period of time, again, their attorney's going to ask, hey, what's the remaining balance on the first mortgage? I got to pay that off at closing. And then they're going to ask IHDA, what is the remaining balance on that $10,000 zero interest loan? And IHDA's going to say, well, it's $10,000 because I never asked you for any monthly payments. And so you'll pay off this $10,000 when you sell the house. Well, what could be better than this? You're giving someone $10,000 to become a homeowner. They got money for now for down payment, for closing costs, and they don't have to make any monthly payments until they sell, till they move out of the house. It's a crazy great program.
Okay, go ahead.
Yeah, Tony.
Two things. So the other trigger for paying it back is if they refinance also. So if rates drop and they want to refinance, what we would do is we would just roll that into the loan amount to refinance and get a lower interest rate.
Makes great sense. Makes sense.
So the triggers are typically like it'd be selling, refinancing, or the 30 years are up on the mortgage.
Makes total sense. Makes total sense. Here is a flyer that is available out there, and it talks about that the new $10,000 program, it's an interest-free loan deferred for the life of the mortgage. You must contribute $1,000 or 1% of the purchase price. That's their entry fee. So again, they have to put up some skin, some money into the purchase price. And it's eligible in all counties. It's not like, oh, it's only Cook County or it's only the collar counties. Anywhere in Illinois, all counties are eligible for this program. My recommendation to you, and you're going to see this later on, I'm going to remind you this, is you should get this flyer co-branded with Tony. You should have 20 of these sitting in your briefcase. As you meet and greet people, you should be handing these out to people to saying, I got 10,000. I mean, who doesn't love somebody who's giving out $10,000? You should be putting this in your social media. You should take a picture of your flyer, put it into Facebook, into Twitter, into LinkedIn, into Instagram, into TikTok, wherever you do your social posting, you should be letting people know you've got $10,000. I don't know about you, but if somebody was, doing that in my social media, I might be paying attention to them and saying, tell me more about how I get the $10,000. So let's look at some of the eligibility requirements. Well, first off, it's available for first-time and non-first-time home buyers with income and purchase limits. So we're going to talk about the income limitation. We'll talk about the purchase price limitations in a second. It's only eligible for single family or for 2-unit. Don't miss this point. 2-unit properties are really great in this sense. If somebody can use IHDA, get $10,000 to buy a 2-unit property, and then all of a sudden the second unit is giving them, pick a number, rents of $1,000, $1,500 a month. And if their mortgage payment is, let's say, $2,500, minus the $1,500 that they're getting from the second unit, they're now living in a 2-unit property, and their out-of-pocket expense every month is $1,000. It's a great, great program. We've helped many a person buy a 2-unit property, and obviously their mortgage payment gets reduced by the rent from the tenant that's in the second unit. The borrower must occupy it as their primary residence, and there's no non-occupant co-borrowers allowed. That's a fancy term for saying no non-occupant. That's mom and dad. That's grandma, grandpa. That's somebody who's not going to live in the place under FHA, under conventional loans. You can have a non-occupant co-borrower, not under the IHDA program. They're only asking you to come up with 1% of the purchase price. So again, on a $300,000 purchase, 1% is $3,000. Most renters have first month's rent and security deposit. If their rent is anywhere from $2,000 to $3,000 a month, they got anywhere from $4,000 to $6,000 sitting in the bank. God forbid that they have to move all of a sudden. So again, they're being asked to come up with 1% of the purchase price as their own funds. Under IHDA, you're getting a 30-year fixed rate, a VA loan, an FHA, a USDA conventional loan. There is income and property limitations, which you'll see in future slides. The minimum credit score, 640 for FHA, USDA, VA, 640 for conventional. Now, if your client does not have a 640, which it's not that hard to get a 640, but if they don't, that's where, again, you give them to Tony, and Tony can do with his credit agency, he can do what if scenarios. What if you paid off that collection? What if you reduce that Visa card from having 50% of it outstanding against your credit limit? What if you brought it down to 10% of the credit limit? How many points would I gain back? How much would my credit score increase? So again, you need a 640, but this is where you need to be talking to everybody and anybody. If they're not at 640, then let's put them into the prospect list that we're working on their credit. They're working on their credit, getting them up to 640. Your debt to income ratio can't exceed 45%. Debt to income. Income is the denominator. Income is gross income, not net income, not their net pay, their gross pay. So if they make $60,000 a year, divide by 12, the denominator is $5,000. So they can't spend their housing payment, their monthly payments on credit cards, their monthly payment on, say, if they have student loans. When you add up all the monthly payments, it cannot exceed 45% of that $5,000 number I just gave you in my example. The borrower must contribute 1% of the purchase price or minimally $1,000 out of their own funds, whichever is greater. And they're going to go through homeownership counseling. It's something they can do online. They can just log in. They can do that. And quite honestly, it's great education for first-time home buyers. Kind of goes through a little budgeting process with them. And this way they can understand that, they need to make sure that they're not overspending each month based on what they bring in net income. The IHDA interest rates, what's so great about this program, there's only one interest rate offered each day by IHDA. This isn't a program that, I got to shop 5 different lenders. What Tony offers as an interest rate is the same rate that any other lender. And by the way, not every lender is an IHDA certified lender. So let's stop and think about that. You must bring your client to a certified IDA lender. And you will hear other lenders say, oh, you don't want to go through the IDA program. It's so much paperwork. It takes longer to get approved. You know why they're saying that? Because they're not IDA certified lenders and they can't offer the program. It's 4 extra pieces of paper at time of application, and the underwriters, our underwriters, underwrite the file. It's not like it takes them any longer to underwrite the file. If they approve it as a VA loan, as an FHA loan, as a conventional loan, it's approved for IDA. The interest rate is the rate for the borrower's first mortgage loan. You're going to see an interest rate schedule in a couple of slides down here. And it's the interest rate that they have on their first mortgage for the FHA conventional or the VA loan. The IDA down payment assistance is a second mortgage. It's a second lien on the property, with only the $10,000 repay program requiring any repayment. Remember, there's 2 $10,000 programs. Repay if they really want to repay it on a monthly basis, or take the $10,000, pay nothing for as many years as you live in the property and only pay it back when you sell the house. So here's today's interest rates. Under the $10,000, no monthly payments, the interest rate on government, which would be the VA and the FHA, is 6.125, and the conventional loans are 6.5. These are the other 3 programs that we talked about. This is the $6,000 program, where it's a forgivable grant, 6.25 if you do an FHA. The deferred, where it's a $7,500. It's just like the $10,000, not payable back until you sell the house, 6.125. And the repayable $10,000 program is 6.125. Here's your income and purchase price limitations. Most of us are working in Cook, Kane, Lake, McHenry, and McLean and Will. So your income limitation is $125,040. And it's very important to understand something here. There's something called the household income, and then there's called the borrower income. So again, I know, everybody on this call knows a lot of people, a lot of our clients make less than $125,000 a year. So immediately you would think they qualify. The old rules were, let's say that the husband was making $90,000 and the wife was making $80,000. Neither one of them were over the 125, but when added together, the household 80 and 90 was 170,000. It used to be, it was a household limit. It is no longer that. It's the borrower. So again, if the borrower, let's say, is making $100,000 and the co-borrower, wife or other spouse, is making $50,000. So combined, they make 150. Well, what we're looking at is the borrower. If we just make the borrower just the husband who's making $100,000, if he's eligible and qualifies and his debt to income ratio is under 45%, we're not going to have the co-borrower be a borrower. They can be on title, husband and wife can be on title, but we're only going to use the husband as the borrower. His $100,000 is less than $125,000. So again, what I'm trying to say here is that the borrower, it's a borrower income limitation. If the borrower's income is under $125,000, they're eligible. So that's one of the green lights. Second green light, well, then the purchase price limitation is another limitation. On a 1-unit home, it's almost $350,000. On a 2 units, almost $450,000. I know that you guys can find some very comfortable housing for your clients that make less than $125,000 and the purchase price is under $350,000. So now all of a sudden, you've got a big pool of people to talk to. You've got social media postings. You can mail out postcards. You're now letting people know you've got $10,000 that you can give out with no monthly repayment to help them become homeowners. So let's look. So now let's look at structuring a home purchase using the new $10,000 program. Let's look at the cash needed to purchase. Let's look at what I call the 3 buckets of cash. Every purchase transaction has 3 buckets of cash. So here we have an example: $300,000 We're going to do an FHA loan with only 3.5% down. We're going to use the $10,000 program that's not repayable. No monthly payments. It's repayable only when you sell the house. So if their rent, you'd rent versus purchase, if the rent was $3,000 or even $2,000 a month, they'd be paying rent of anywhere from $4,000 to $6,000 if they were renting a $300,000 house. Now, if they purchase, bucket number one is down payment. Well, what is 3.5% of 300,000? Well, it's $10,500. People say, hey, Tony, hey, Marion, I don't have $10,500. It was really nice talking to you, but we're going to have to come back to this at a later date. I don't have $10,500. But then what you say is who pays? You, the borrower, you have to come up with 1% of the purchase price. You just told me you had anywhere from $4,000 to $6,000 if you rent. Can you give up $3,000 of it and put that into the down payment bucket? Which means then IHDA will come up with $7,500. What is $7,500 and $3,000? Well, it's $10,500. Put a check mark. You got all the money you need for bucket number one. Bucket number two is closing costs. The closing costs on average are about anywhere from $5,000 or like $5,600. And then IHDA charges a 1% of the loan amount as a fee, as an origination fee. So let's just say that your closing costs are around $8,000. Well, again, you have to say who pays, because the customer is going to say, guess what? I don't have $8,000. Couple things to remember here. IHDA can pay. IHDA's got $2,500 still remaining in that $10,000. They only use $7,500 for the down payment bucket, so there's $2,500 still remaining. Now, in today's environment, possibly the seller may or may not be able to give a credit for $5,500. One of the ways the seller can, because again, sometimes sellers are getting multiple offers. Sometimes you're using what's called the sure to close program with Tony, where you can go in and make it look like it's an all cash offer by having your client's file underwritten within like 24 to 48 hours. And we give them a certificate that says we guarantee you're going to close. And now your offer looks like an all cash offer, not contingent on financing. But again, when can you get the seller to actually give you a $5,500 credit? Well, once you've identified the table of expectation, what I mean there is the purchase price. Say they started out at $310,000 and the client offered $290,000 and you all met in the middle at $300,000. Great. But before the client signs the offer to purchase, you, the realtor representing the buyer, pick up the phone, call the seller's agent and say, my client no longer wants to pay $300,000. The agent on the other end sighs and says, now what? You say, my client wants to offer $305,500. He wants to offer more, provided that the seller will give them a credit of $5,500 toward closing costs. So the table of expectation is still being met because the seller's realtor, the seller's attorney says $305,500 new purchase price minus the $5,500 credit still gives them the $300,000 that they were expecting. Last but not least, if for some reason that math doesn't work well with the seller, perhaps you can get a gift from a blood relative who can then give the buyer a $5,500 gift, which then can be used toward closing costs. I would, however, let the realtor negotiate for the client and up the purchase price, provided that the realtor feels that the property can appraise out at the $305,000 level. So assuming that you do get the credit from the seller for $5,500, putting in $2,500 from IHDA, the borrower is going to come up with zero in bucket number two. Bucket number three is what they call escrows for real estate taxes and homeowners insurance. And it depends upon the month that you close. The important thing to remember here is in the state of Illinois, we pay our real estate taxes in arrears, which means that in the year 2023, we're paying real estate taxes for the year 2022. So here we are in the month of June, and let's say that we go to contract in June, and we're going to close at the end of July. So who's lived in the house from January 1st, 2023 to July 31st, 2023? The seller. The seller owes our client 7 months worth of real estate taxes as a credit. The important thing to take away from today is that credit always exceeds what the lender is going to ask the borrower, our client, to put up into the escrow at closing for real estate taxes. So yes, there is going to be a funding for real estate taxes and for homeowners insurance to initialize the escrow for the lender, but the credit from the seller will more than enough fund that. So bucket number 3 is always 0 unless it's new construction, and that's a different discussion that we can have. But it's 0 because of the real estate tax credit. Bucket number 2 is 0 because of IHDA and the seller credit. And bucket number 1 for down payment is IHDA and the 1% from the borrower. So the long and the short of it is $3,000 plus 0 for closing costs plus 0 for escrows is $3,000 out of pocket, or they can come up with $6,000 or $4,000 for security deposit and first month's rent. I think I know which one your client would choose if you were to lay this out for them in this manner. So here's a short quiz with the 3 buckets of cash. What if the earnest money, when you're putting together the purchase contract, was equal to 1% of the purchase price? The 1% being the minimum that IHDA wants to see your client put into the transaction. How much cash would your buyer have to bring to the closing? Theoretically, 0. If you get that seller credit by upping the purchase price and asking the seller to then give that closing cost credit, theoretically, your client would be bringing 0 to the closing if you made them give the earnest money equal to 1% at the time of the contract being accepted. So what is the housing expense on a $300,000 home using the $10,000 0 interest loan? Let's assume that the interest rate is 6%. Well, principal and interest would be $1,766. Down payment, there is no monthly payment, remember? We don't have any on that $10,000, there's no payment until we sell the house. The real estate taxes are $553. The homeowner's insurance is about $100 a month. And the private mortgage insurance is $204 a month. The grand total is $2,623 versus say $3,000 in rent, $2,500 in rent. They can make this payment. If they can make a rent payment, they can make a housing payment. And then what if it was a 2-flat? Then they can subtract the rent they receive from the second unit and drop this $2,600 down to maybe $1,600. So let's summarize the 3 buckets of cash. Bucket number 1, who pays? They can, or IHDA can pay. And again, it's 3% down for conventional, with high credit 5%, with lower credit. FHA is 3.5%, but it's only 1% is what's needed. It's their share of the down payment if they use the IHDA down payment assistance programs. Bucket number 2, closing costs. Again, always ask who pays. They're really approximately more like $5,600 with an additional 1% fee if using the IHDA funds. So who pays? Well, you, the borrower, they can pay, yeah. IHDA can pay, and or the realtor can negotiate to have the seller pay, either outright agrees, or they ask the seller after the table of expectation has been met, after a purchase price has been agreed upon, before the buyer signs the contract. They ask for $5,000 or $5,500 more for the seller's home. Nope, but I want to pay $300,000. I want to pay $305,000 for this house, provided the seller pays $5,000 of the buyer's closing costs. Lastly, your lender can pay some by charging a higher interest rate on non-IHDA loans. So again, how much of your customers or your clients or the borrower's own funds were used for closing? Well, if IHDA pays and the realtor gets the seller to pay, you're coming up with 0. Bucket number 3, the prepaids and escrows. Always ask who pays. We know prepaid interest is interest from the date of closing to the end of the month. So if we schedule our purchase to close on July 31st, they're only going to pay 1 day's worth of interest. That'd be a smart structure. On escrows, you're going to be putting up anywhere from 2 to 3 months of homeowners insurance, and you're going to be putting up anywhere from 2 to 8 months of real estate taxes at the closing. But again, Illinois, You pay your real estate taxes in arrears. Therefore, the seller must give a credit for the real estate taxes while the seller lived in the home. In our example, they lived in the home through July 31st. They have to pay 7 months worth of real estate taxes as a credit to our client. And that credit turns this bucket into a zero amount out of pocket for our client, except on new construction. So how much is needed at closing? Bucket number one, 1% of the purchase price. Bucket number two, 0 if Ida and the seller are paying the closing costs. And bucket number three, 0 with the seller giving us a credit for real estate taxes. So what is your client waiting for? What are you waiting for? Take some action. Now that you've reviewed how little cash is needed, what's your next step? Educate, educate, educate your prospects. That means get a flyer. People, it's great to hear this verbally. You need a written document. You need the flyer. You need something in your briefcase. You need 20 flyers in your briefcase. Everybody you meet in the grocery store, at church, your family, your friends, you need to give them a flyer and say, I've got $10,000 with no monthly repayment. Give them a co-branded flyer. Provide a monthly. Here's another thing. How many of you on this call are doing monthly home buyer seminars? Tony's been doing monthly home buyer seminars with select realtors because they say, hey, Tony, hey, Glenn, I can get 6 to 10 people every month to attend a home buyer seminar. And they go through this and a little bit more, and they educate them on how easy it is to become a homeowner. Why aren't you guys doing this? You're using Tony's Zoom software. Tony creates the invite. All you have to do is take the link to the registration page and the invite and send it out to all of your clients. It is one of the easiest things to do. And all you have to do is invite people. People that you as a realtor, you're bumping into people all the time that potentially would love to become homeowners. Start doing home buyer seminars for free by having Tony Marino be your guest speaker and use his software. He's already got a 35, 40 slide presentation on this home buying seminar. So what is your goal of your homework today? What should you do next before your client buys a home? Get them pre-approved for free. Use FCM Express. Go to your Play Store, go to your App Store, download FCM Express, and Tony, get a hold of Tony. He will co-brand it. Your FCM Express will have your picture, your contact information on it. You can start sharing it with all these people you're giving these flyers for, the 10,000, and to see whether or not they have a 640 credit score. Remember, 2 green lights, 640 or better credit score, and do you make less than $125,000 a year? 99.9% of them will say, yep, I make less than 125, but I really don't know my credit score. Great, give them FCM Express, have them fill out the online application. Tony can then pull their credit, and he can then either counsel them to get it up to 640, or he can move on to the next step, and that is get them pre-approved. Obtain a free credit report. Do credit rescore if it's not at 640. They can assemble the necessary documentation, get automated underwriting, get a pre-approval letter. And again, in this environment, if you want to be very competitive with your client once they're pre-approved, take them to the next step and ask for what's called a sure to close certificate. Sure to close. Now you do not have to check the box. When you have a sure to close certificate, you do not check the box on the contract that says it is subject to financing. You can do it. This is an all cash offer because First Centennial guarantees it, and they guarantee up to $10,000 of the buyer's earnest money. God forbid that they should not close for some reason. Now that you have a yes for your loan, go shop for a home. Review an action plan with Tony if action is needed. Start hosting those home buyer seminars. That's your homework. We want to thank you for today. Our commitment is to get your people pre-approved in 24 hours. Let's start getting people to dream of home ownership. It's not that far away when you give them $10,000. Download FCM Express from the Play Store or the App Store. Get your people pre-approved and give them a free calculator through FCM Express to compute their mortgage payment. Any questions? Unmute yourself.
Just one quick thing. For the sure to close, we cannot do it with IHDA, so it would just be for conventional or FHA by itself.
Thank you for clarifying that. And again, for those that want a co-branded $10,000 flyer, put your name in the chat box or get a hold of Tony over here at T.Marino at gofcm.com. Just email Tony, or you can call him, or you can text him and say, Tony, I want to start handing out these flyers to anybody that I meet. I want to give away $10,000. If I was a realtor, I'd be giving out $10,000, making people pay attention to me. If I was a realtor, I'd be putting it into my social media, making sure that I'm going to try and beat out some other realtors who are not advertising that they can give away $10,000. Any comments or questions?